Hey everyone, thanks for joining us. Today we have Karthik and David with us. So I'm gonna give a very quick intro about Karthik and David. After that, I'm gonna leave it to Karthik, who's gonna lead the conversation. So quick intro about David. David is the CIO of WinCap. He's been working with CIO for 32 years. Again, very few people you're gonna see is a career LP. Kind of in a weird way, he started his career in LP. That's also a story. Maybe you should ask him. So he started as a LP with WinCap, and now still he's working has seen more than investments more than in 450 plus funds. And again, there's a lot of models they have evolved, like how today they are sticking with established fund managers and what do they see in established fund managers. So David's gonna talk about that, so I'm gonna leave with that. So next, moving on to Karthik is the managing partner and founder of Bloom Ventures. So again, most of you know Bloom is one of the most iconic large domestic homegrown VC fund, again investing in early stage founders. And again, they have multiple things, they have evolved their model. So Karthik is a proponent of India, and again the India story. So yeah, uh, I'm gonna leave it to Karthik, why don't you give a little bit intro and then lead the conversation.
Hey, thanks, Pavitran, for having us. Thanks, David, for joining us. I think it's important for for the Indian ecosystem to hear from global, sort of the best in craft of best in venture craft globally. We sometimes have the privilege of coming and meeting you folks, and in both on Indian shows and in your offices, and learning and picking up nuggets. But it's great to see LPs like Vencap becoming more vocal about putting out data there to support all the learnings from the last 30 years. So I think, David, you had a tweet thread about a year ago, which kind of kicked off a bunch of conversations around, finally seeing hard data around what everyone understands as the power law. And just for people who haven't seen that thread or haven't seen the graph, very quickly, Vencap had looked through 260 funds over 32 years, which they'd invested in, 11,000 plus companies invested through those funds. And 53% of them didn't deliver more than 1x. Only 19% 1 to 2x, 16% 2 to 5x. Only 5% delivered, 12% delivered greater than 5x, 5% greater than 10x, 1% which delivered fund returners. So I think that triggered a lot of conversations around how acute the power law is in early stage venture capital. And David, I think you know you might have gotten hundreds of reactions. Did you get any interesting counterpoints to this? Like, there are exceptions to this rule. Um, and I will share things I've heard from other LPs as well. But I was very curious to understand: has someone come and said, "No, this is not fact, this is not accurate data," or does everyone believe that this is the way venture capital will continue to play out, not just for the first 50 years of venture capital, but for the next few decades?
Yeah, I think some interesting things, and just to say, great to be here today. We've been investing in India for nearly 20 years, and love coming over to India. Always a great place to travel to, and hopefully be able to meet a few people in the flesh next year. I'm sure I'll be over next year. But just in terms of the power law. I think the data didn't really surprise people. I think there've been a few other firms that have published similar findings as well. I know Stepstone came out a month or two ago and put something similar that was out there. But I think people intuitively realize that venture capital is risky and a lot of companies fail, but I don't think they really appreciated just how significant the power law was. And so, funnily enough, we've just updated the analysis
Okay.
to June this year. And what we find is pretty similar, but it's perhaps even more extreme. So when we look at the number of companies that don't return capital, that's now for early stage funds, for mature early stage funds, that's now 60%. So 6 out of 10 companies are loss making in a portfolio. And of that, about 25% of companies return nothing. So are zeros.
Yeah.
And so I think that's just the reality that people have to deal with when they're thinking about venture. And even when we look at the best performing funds, the loss ratio is still high. It's still, getting close to 50%. So 1 in 2 companies failing to return capital. I think the thing that really VCs need to focus on is how do they manage to the other end of that curve? How do they look to optimize their ability to generate those 10x performers and ultimately, hopefully, those fund returners? Because I think if you're going to deliver a 3x or better net performance to investors, it's going to be almost impossible to do that unless you have a fund returning outcome.
Yeah.
I guess the question is, is that true in all geographies, and is it true going forward? Certainly the data we've seen suggests it has been true across geographies. So, most of what we do is in the US, but we're active in China, we're active in India, we're active in Europe, and we've seen the same power law analysis work there. As to whether or not it's going to continue to be at those sorts of levels going forward, I think in the US it is, and I might even argue that we're going to see fewer winners, but larger winners. So I wouldn't be surprised, certainly over the next 5 years, if the power law actually concentrates. The interesting one for me is what's going to happen in China. I think there's an argument there to say that the power law might dissipate a little bit as the China market moves away from consumer internet and more into sort of deep tech, advanced manufacturing, robotics, those sort of areas where we tend to see a slightly lower loss ratio, but we see a lower, the winners aren't as large. So yeah, that's generally how we've thought about it.
Thank you for that. No, I think there were 3 dimensions that you brought up, which are yet to be tested. In my opinion, when you have these, now the world's kind of gotten divided into the smaller, either specialized geographically or specialized sectorally, manageable kind of fund sizes. I feel like I'm touching the precipice of that when I do $250 to $300 million funds in India myself, right? I think anything larger than that, and it kind of spooks you on whether you can return that kind of capital, a multiple of that in a single vintage of 3 years. So one is the size. Like, that's fine. All of what you said might apply to a fund size, but is there a limitation until when this actually plays out in the conventional venture way? And what happens, and why are LPs backing, $7-10 billion funds? What is that game about? And not that anyone here on this call is probably intrigued or interested in that game. I think what Pavitran has put together as an audience is usually early stage, venture, classic seed to Series A kind of managers. So I think one is from the vantage point that you're in, what do you think about that trend line? And then, you brought up an interesting point where you said in China, because there is a shift away from consumer back to deep tech, and the government has a view on what touches consumers, should they have an opinion on it. But does deep tech lend itself to these early cycles of DPI and multi-billion-dollar kind of takeoffs, which we started seeing from the Amazon Google era? But prior to that, venture was even more patient game. Like, the inflection points came much later, because a lot of venture funded deep tech, which doesn't magically play out in like 2, 3, 4 years. It takes 5, 7 years to mature, and you're truly buying into new technology cycles. So that seems to, of course, have taken a very different path in the AI tech cycle or hype cycle, whichever you believe. And what happens when certain parts or certain fund managers focus on true deep tech and true sort of frontier innovation? Do they have to play this game differently? And then the last part, which both of us can spar on towards the end, is the India piece. So we leave that for later. But maybe it'll be interesting to get your views on, what happens when the mix moves away from the Swiggy, Zomato equivalent of China or India, and because we haven't seen tons of deep tech unicorns, for example, in India. And secondly, as I said, you may or may not participate in these funds, but do you see a rationale of these $5-7-3 billion kind of funds with General Catalyst and Lightspeed and a bunch of these companies?
Yeah, so the deep tech side first, we are quite skeptical about deep tech as a venture financed sector, because we just haven't seen it work historically.
Okay.
And that's not to say it's not going to work going forward.
Yeah.
But I think there's a lot of challenges that we see around the deep tech space.
Hmm.
One is that it takes a lot of capital, and
Hmm.
it's challenging to de-risk that capital as it goes into an investment. If you're investing in a software company, it takes, once you've got product market fit, most of the capital is then going in to scale the business. And you've got metrics that there's people there that want it. You can see your retention rates, you can see your user rates, your growth rates. There's a well-established playbook for understanding whether what sort of curve your company and your product is on. And so I think with software companies, I think you are able to de-risk as more money gets put in and the company develops. For
That's right.
deep tech, you're looking at R&D periods that couldn't be 8 to 10 years before a product comes out on the market.
Hmm.
And there's no guarantee, one, that the product's going to work, two, that you're going to be able to manufacture it in a cost-effective way so that economically it's a solution, and
Yeah.
three, that the market's still going to be there once
Yeah.
you've got that product out there.
Yeah.
And then also, we look at the scale of the deep tech exits. There are very few of those that we've seen
That's right.
that would qualify for a top 1% exit globally. So
Hmm.
I think there's a lot of challenges. It's not to say you can't be successful, but I think there are a lot of very different challenges in the deep tech space, and for that reason, we would need to see strong evidence that the market has changed and those challenges can consistently be solved before we would look to commit into a deep tech fund. The only difference.
Yeah, go ahead. Sorry. Yeah, go.
I was going to say China's the interesting one around that, because I think because of their supply chain and the cost of manufacturing is fundamentally different in China. That if it's going to work anywhere, I think it's going to work in China first. But even there, we're still not convinced it's something we really want to sort of play into.
Yeah, I mean, the biggest drone manufacturer in the world is there. I mean, obviously, you have the history of like Foxcons of the world and the biggest handset manufacturers outside of the Apple, Samsung combined. So there are evidences of that. I agree, and no, I think the corollary to that, from what little I know of venture history, and you know much more of it than I do. I picked it up as a student, literally in '99 when I landed in the US shows for the first time, and basically picked up from that and read back and saw the history of venture. And I think it was also very seductive and appealing, and it made a lot of sense because the size of outcomes, if you actually built some really cool technology that IBM was willing to build or buy, or when DeepMind was bought by Google 10 years ago, a $400 million exit on a fund size which might have been 150, 200 million looked very appealing to me. Some European VC made a lot of money on that and may not have made a fund returner, but it might have made 0.4x or 0.5x. So the acquirers typically in deep tech, had a finite budget, but they were willing to buy. And when your fund size was small and the amount of dollars that went in was small, I think the outcome looked somewhat respectable. But when you start raising 300, $500 million funds, it's very difficult to justify, as you said, how you can get a fund return out of deep tech unless you're building a $5-10 billion company. And we haven't seen too many of those. So I think I agree with you on those. And the second one, I would love for your thoughts on what happens to these mega large funds. Is this like a new trend line on saying, when there's a paradigm shift in technology, we go all in and we are like the best managers in the world, so we can get the best entrepreneurs to come and take multiple $100 million from us? Is that the game there?
Yeah, so I think there's a few things there. First of all, I think we need to sort of unpack the idea that people are raising $7 billion funds. So people like Andreessen and Lightspeed are not raising $7 billion funds. They may have 3 or 4 strategies that together are consisting of $7 billion, but they are separate funds. Their early stage funds are around $1 billion, give or take. There'll be several of those on different strategies or different parts of the market, and the largest growth fund that we've seen has probably been around 3 to 4 billion. So just to make sure what
everyone
clarifying.
understands that it's actually a set of funds rather than a single fund.
Yeah, exactly. So it's not about one company returning $7 billion back to a manager. For an early stage fund, realistically, you're looking for a single company to return $1 billion or more. for that. And I think for us, we look at it very simply, which is how often has that manager done that historically? So, there are some managers that have got a much better track record of having individual companies that return $1 billion back to their early stage funds. And so that means we would have more conviction on their ability to do that going forward.
Yeah.
There are other managers that haven't been able to do that. And so, we would be unlikely to do that. But I think what you have to look at there is the relationship between, what sort of exit size and what sort of ownership at the time of exit do you have to underwrite in order to see that manager deliver a fund returning outcome for the early stage funds. And for us, $1 billion, as I say, we've seen that happen 45 to 50 times historically, where a single company has been a fund returner and returned $1 billion back to a single fund. So it's not impossible. It's not easy, and that's one of the reasons why we only have a very concentrated group of managers in our portfolio, because generating those fund returning outcomes consistently is exceptionally hard. I think for the growth funds that are larger, the model, you still need to have, there's still a power law dynamic in place, but it's less pronounced because you have a slightly lower loss ratio. So instead of it being 60%, you're probably in the sort of 35 to 40%.
Yeah.
But it's interesting when we look at 3x growth funds, there's still 83% of those that have generated a fund returner. So you're still getting fund returning outcomes from larger funds and later stage funds, but it's not quite as essential as it is for an early stage fund. And I think what our preference would be on the growth funds is we like to see more concentrated portfolios, so that you still, you're not investing in 50, 60, 70 companies where none of those are going to move the needle. Even if you have a $2 billion fund, if you're writing checks of $100 to $200 million, a 10x outcome on one of those is still going to move the needle at the fund level. And so that's really important for us, is that we have to see an individual company, even at the bigger fund sizes, be able ideally to return half a fund.
Just for folks who may or may not understand my own predicament at Bloom, if David, you might know some of this because we've spoken to the team before. We went from 20, 60, 100, 102 million to 290. So people said, how are you figuring out the math on how to return like a $290 million fund, which is like more than 1.5 times everything you've raised in the last 3 cycles, right? So one is obviously we're expecting the market itself to have moved. At least there's a dream of a Swiggy today and a Zomato today, which wasn't there 8 years ago. So your outcomes, even if you don't get $15 billion outcomes, you might get a $1 or $2 billion outcome with far higher probability. But interestingly, the point that you made about how even what happens in a $5 or a $7 billion fund, that it actually is a subset of strategies. That's the only way I'm able to rationalize even $250, $300 million, to be honest, to be able to see this as a subset of 3-year strategies of anywhere between $50 and $75 million. Otherwise, that whole math that you just described of trying to return funds or trying to return like a multi-bagger on a fund becomes very, very challenging. Of course, only time will tell whether my strategy plays out into the next decade, because we started this journey in late 21, early 22. But that's the only way even I'm able to rationalize such a small fund size in a market like India. So I just wanted to throw our perspective in. But the one
thing I would say, sorry, Kartik,
you were saying something.
The one thing I would say there is that the one thing we have consistently got wrong as LPs over the last 30 years is that we've underestimated how big the best technology companies can be.
That's correct.
And every cycle we underestimate it. And I think one of the things we've learned is that the very best companies consistently surprise on the upside when it comes to how quickly they can grow and how large they can get. And when we look forward in 10 years' time, I think the bet we're very happy to make is that the cohort of the leading tech companies 10 years from now will be bigger than the last cohort of leading tech companies that we saw emerge from the VC industry.
We've seen it
and if we were seeing 20, 30, 40, $50 billion outcomes this time round, then we think we can see that increasing. over the next 10 years. And so I think it's important as well to realize that we need to compare fund sizes today with exit sizes in 10 to 15 years' time,
I
not
fully agree with you.
exit
Yeah.
sizes today, because the fundamental bet that we will make is technology is only going to get more important. It's going to capture a greater share of the economic pie that's being created. And ultimately, the winners in that ecosystem are going to get increasingly large.
No, amen to that. I mean, that's why you love what you do, and we love what we do. So hopefully the entrepreneurs that we pick will prove us right. So I just want to summarize what you said. I think we showed this last year when we disclosed our Fund One results in the public domain through Omega Files. We called it Omega Files. Give it a cute name. We called it Episode One. I want to keep revealing more data as much as I can. And for us, the math in a very distributed fund of 70 odd companies was still 16 companies, 17 companies, which was about 40, 20, how much is that? 17 or 70, but 25% of the fund companies returned 99% of the capital. So, but then when you double clicked on that, within those 17, three companies delivered 50% of the entire fund, right? And so when people, why didn't it strictly follow the power law? Because we actually diversified far more than typically a fund would do. And Indian outcomes were kind of middling outcomes. The founders didn't give up. They didn't give up when they ran out of money. They bootstrapped for 4 years, 5 years. There was a lot of peculiar behavior from that half of the decade. But to summarize what you said, David, I'd first heard this from a gentleman who was at Horsley Bridge, who was a very similar fund house like yourselves. It was exactly 10 years ago. He told me, Karthik, seed fund, Series A fund, Series B fund, 60, 70 investments, 30, 40 investments, 15 to 20 investments. It's always five companies, give or take one company, which return 90% of capital. And if you're a top decile or top quartile fund, you have to have a fund returner. I first heard it then. And that's how internal conversations are sort of complete only when I know everybody in the team has understood this. That's the prize. Yeah. And I think the reason we're reiterating this is, as a young fund manager who's listening in on today's call, I tried to argue this out and said, no, it will be more democratized. The results will pan out in a more democratic fashion. They just don't. And it gets, and 2 years passed and you thought you had 10 winners. They suddenly shrink to 7, and then they shrink to 6, and then 5. And then finally it comes down to lovely dovetail into the power law. And so don't get fooled by early signs, as we were in, misty-eyed, starry-eyed in 2016. By the time we reached 2022, we were much wiser for that. So, quickly switching gears, I want to touch 2, 3 points before we open up to Q&A.
Sorry,
One
Kari,
was,
can I just jump in
yes,
just
of
one
course.
comment on what you've said there, because I think it's really important that
Yeah.
people understand what does that mean from a portfolio management perspective.
Yes, please.
So if you accept that there's going to be 2, 3, 4 companies in your fund that ultimately are going to drive the bulk of performance, what we found is that the best managers are able then to identify which companies they are, double down in them by using reserves, so they're filtering more of the fund into those. And then also, if you have one of those top 1% companies in your portfolio, in a way, the worst thing you can do is to sell it early, just to get some DPI back to your investors. Sell the second best companies in the portfolio early. Don't sell your crown jewels prematurely, because you're not going to be a top decile fund if you sell your very best company prematurely. And that can be an even harder decision when you sell out, when you take money off the table, than actually when you put money on the table.
It was one of my questions, and I was going to ask you this: that under the pressure of DPI, which is constantly there, because you're an emerging manager. Most of us on this call are emerging managers. We didn't land into India with like pedigreed brands behind us, and so there's a little bit of a leap of faith when you're an Axel or a Sequoia, and you have delivered outcomes. People are willing to cut you a little bit more slack. For us, we're being judged perfectly by like what the top quartile funds in the US are doing, which in itself has most of them have a 15, 20-year head start on us. So there is pressure to show DPI at one level. And on the other hand, I'm a believer in exactly what you said. How do you balance that out, David? Like, what's the right indicator for a timelining of DPI? Since you took me down that path. I want to see if what is your expectation in the best of managers? I'm not talking about India or me or anyone else, but in the best of managers, what have you seen as a natural DPI flow? Sixth to eighth year, eighth to 10th year, 12th year, and then what's usually residual after that?
Yeah, I think it very much depends on the stage of the, where the fund is investing. So, what it looks like for a seed fund is different to an early stage fund, is different to a
Fair enough.
growth fund.
Some idea would be good in whatever class category you
Yeah.
want to
So
specifically.
what we found. So I posted some thoughts on this a few months ago on X, because we looked at what's the correlation between DPI in year 3, DPI in year 5, and final DPI.
I
And
saw
what
the
we
tweet
found,
thread. Yeah, it's
yeah,
fascinating. Yeah.
and what we found was that DPI in year 3 or year 5, there's very little correlation to where that fund is ultimately going to end up. And if you think about it, it makes sense. We know it takes 10 plus years for companies to go from being founded to going public these days. Swiggy's a great example. I think Axel backed them in 2014, 2015.
That's right.
So
That's right.
it's been a 10-year journey for Swiggy to grow and get to the stage where it can go public. And if Axel had kind of gone, by year 5 or year 6, we want to return money, we want to get some DPI, and had sold their Swiggy position, then they would have really missed out on an unbelievably successful investment there. So I think, for us, we really want to encourage managers to play the long game with their best companies. That's not to say that you can't de-risk a little bit and take a little bit of money off the
That's right.
table as you go along.
That's right.
We've seen that. We've seen it with Swiggy. We've seen it with Flipkart. But you still need to have a material position to take advantage of the value creation that happens in year 8, year 9, year 10, and sometimes even beyond. And so what I'd say for managers is kind of understand what your cash flow profile looks like, and make sure your LPs understand what your cash flow profile looks like. Because the way that I want to manage DPI is not by telling my early stage managers they need to sell companies early. It's by making sure I have a portfolio mix in my portfolio that is, has some seed, it has some early stage, it has some growth. And then we also are active on the secondary side as well. So we'll invest in, we'll buy secondary positions in funds. And so it's through the growth fund investments and the secondaries that we will look to manage the duration of our portfolio and to get money back to our investors by year 4, year 5. We don't want, for the seed and early stage managers, we want you to take the most amount of risk you possibly can, because that's how you're going to get the biggest outcomes you possibly can. So having those conversations, I think, with your LPs, and look, this is our view. All LPs will have different perspectives on this.
Yeah.
But I
As
think,
most of my fellow managers will realize, they're very different. And I think you folks in doing venture fund of funds get this the most, because you're so focused on that category. Others are all distracted and informed by different data sets. So sorry, David, if you're finished, then I'll move to the next question. But you wanted to add something?
No, that's great. Please move. Yeah, we can go on.
Yeah. So I think I think you said you have suddenly started concentrating your manager list, trimming it down dramatically, because I think you're looking for these trend lines um, around who has the best right to win these top companies. So when you went through that decision framework, what you don't have to disclose all the managers who came out on the other side of the funnel, but what are the characteristics of selections? Now you're very narrow in your selection right now.
Yeah, so the way we looked at it was, again, it's really going back to first principles of the VC industry, which, when we looked at the return concentration at the industry level, what we found was that about 1% of exits generated over half of the exit value that came from the entire industry. So you're looking at, and this is globally, so you're looking at roughly 30 companies a year It varies depending a little bit from vintage to vintage, but it can be anything between 20 and 40 companies a year. Ultimately generate more than half of the overall exit value created by the entire VC industry globally. So that was the first thing we kind of looked at. And then it was a case of looking at, well, who are the managers that are consistently backing these top 1% companies? And what we found is there's a relatively concentrated group of VCs that are consistently able to find and back those companies at the C, the A, or the B round. And then we kind of layered on top of that the fund returner dynamics. So, yes, it's great to have one of these companies in your portfolio, but if they're not much more than a logo on your website, then it's not interesting to us as an LP. We want to make sure that 1% company really moves the needle at the fund level. So that was the next kind of filter we had. It was, can you get into these 1% companies consistently, and are they moving the needle at the fund level? And so when we pulled all of that analysis together, what we found was there's probably 30 to 40 firms that would be in our investable universe. And we're invested in half of them, let's say. We've got a portfolio of about 14 to 15 managers. And when we look at a new manager, the first lens we look through is, have you backed a top 1% company? Because the experience we've had is that once you've done that, your ability to do it again increases materially, and it becomes much more predictable, which from an LP perspective is really important, because if I've only got a certain number of bets I can take, and I want those bets to play off consistently. I don't want to have to make, if I was investing in, we were looking, there's probably 3,000 or 4,000 emerging managers in the US these days. Trying to figure out which one or two of those emerging managers are going to be successful from an LP's perspective, I think is impossible. So we would much rather go and say, okay, our challenge is, once we found one of those managers who we think can predictably back those top 1% companies, our challenge is more, can we access them? And that's how we would look to spend our time, is developing those relationships and trying to build access into those managers.
So two little examples, or two little parables. One is, of course, I heard this first when I was raising my first fund, and I think we've tried to build Bloom aspirationally to that, which is, there's a valley paradigm. The best VCs don't find the best founders. The best founders find the best VCs. so basically, you got to be able to build a brand that people really want to work with, and it's a very slow churn to get there, because a cyclical virtuous cycle to get there, because fundamentally they have to believe that they're getting into the Harvards or the similar in who they believe will probability of that grand outcome as well. Of course, 90% of the work is theirs, but if they're going to associate for capital, then that 10% probability, they want the highest probability. So eventually they want to work with great investors. The second is, I got dinged in my new fundraise just yesterday evening from somebody who said, Karthik, basically, we really like what you guys do, but unless you evolve one step further, you're like almost there. We'll see where you get to in the next fund, in terms of like hitting all of what David outlined. Are you getting the best flow? Are you looking more like a Series A investor? Are you too scattered in terms of your concentration of what's the point of having the other 25 companies too early, which will never become that $1 billion, $10 billion company? So I think as we've evolved, we've realized that unless you strike that zone, you're not going to be like that top decile every cycle kind of a manager. And that's what I think we all have to work towards. But David, have you seen anybody, you've seen this industry for 30 years. Have you seen anyone pull this off other than Andreessen in less than like 10, 15 years? That's the other thing I want the managers to hear here on the call. Is this possible to build like world-class franchises of that kind from bottoms up? Unless you've spun out of Andreessen or spun out of Sequoia. Can you actually build that in less than 10, 15 years?
Yeah, I think it takes time, and I think it takes I think you have to play across a whole cycle. And so if you think we haven't really seen a proper correction, or we hadn't seen a proper correction in the VC industry, since 2008, 2009.
That's right.
We had a 12-year bull market, and
Yeah.
so it was really, really hard to differentiate yourself as a VC manager during that time, because everything looked great. Everybody had companies that raised follow-on rounds at much higher multiples. Everyone was showing strong TVPI, strong IRRs, perhaps less so on the DPI side, but certainly paper gains were very much there. I get the sense today that we're going to see a lot more differentiation between managers, and which is great from an LP's perspective, because actually you're getting much more signal today than you were 3 or 4 years ago. And there's much less noise to cut through. So I wouldn't be surprised if over the next few years, we see some firms emerge that have, really been able to back those key companies of the next generation. And they will really sort of stand out from their peers. It's probably a little bit too early, to say who they are at the minute.
Yeah.
But I do think every cycle, I do think we'll see a handful of firms really emerge that have evolved the VC investing model, that are bringing something different to the table, that maybe specialists in a particular space that is really starting to develop, and we're able to get in there early and take advantage of that. So I am hopeful, and one of the things we're looking for is are those types of managers. So, back in 2010, 2011, 2012, we ended up investing in 3 or 4 managers that were new to us at Fund 3 and Fund 4, because it was very clear in their prior funds that they had some of those franchise companies in there. And I think, our expectation is that over the next couple of years, there'll be the opportunity to add, 1 or 2 names at that. It might be a Fund 4 and Fund 5 because time cycles have compressed, and so funds get invested much faster, and it just takes a little bit longer for those companies to really emerge. But
That's right.
But yeah, I think one of the things I tell our team all the time is that we need to be on the lookout for that newer group that really has momentum, and we need to get and build those relationships, and I think we'll find those emerge over the next year or two.
Awesome. No, I think we'll take a pause. I know you had one sort of counter question for around liquidity and the IPO market. We spoke about it a few weeks ago, and then we have a blockbuster IPO to talk about today. But before I sort of, you want to ask me a question. I think you had some questions around how we see the exit paradigm in India. But before that, I looked at some of the data in terms of those multipliers, right? And you had done some math also around how some of the largest multipliers in the history of venture, like Coinbase, Google, Slack, etc., were very capital efficient and generate huge outcomes. So either they have to become 50 to $100 billion outcomes, or either they have to be capital efficient, and that's when these magic happen. And then I think someone asked you a question about, does everything have to be that large? And actually, if you put a lot of reserve money, even at 20x, you can get like a fund returner because of the number of rounds you've played. So, but I think from what I took away from that exchange that you had with some reader was, I think 15 to 20x on a company which is a leader in your pack, where you've played enough reserves, is like table stakes for like at least the beginnings of a decent fund with a fund returner. Am I right in saying that for the audience's understanding?
Yeah,
because the ones which are below 10x really don't move the needle for you, right?
Yeah, I think it's very hard. Funnily enough, I was just looking at our fund returner sheet, and looking at the sort of multiples that we were seeing on that. And if I'm looking at the biggest outcomes there, we're looking at average. Yeah, I think you probably need to be shooting for things that are bigger than that. So 15 to 20x is probably the sort of very minimum. I think really to get those fund returning outcomes, you're looking at sort of 30, 40, 50x in terms of an individual fund multiple.
Got it. Got it. Got it. No, that's a great cue. What do you think about India and the way it's exiting today, and most of our exits looking like they're more going to be more public market driven? Yeah, I'm kind of biasing you because that's what I believe. Are you hearing anything different? Are you asking us to set up our outcomes for anything different, or fundamentally are we going back to fundamentals outside of this freak 12-year bull cycle and saying even prior to that it was Facebook, Google, Amazon, etc., Tesla, they were all publicly listed companies very early in their life. You think we're going back to that era and we're going to see
Yeah, sorry, Kartik. I think we just
Yeah.
lost you there. I can pick that one up. Hopefully we can reconnect shortly. Yeah, I think one of the challenges that we've seen around India generally it's been really hard to generate sizable exits. For a long period of time, really the only material exit was Flipkart, and that was obviously an M&A transaction. The great thing that we've obviously seen over the last couple of years is the Indian IPO market begin to open for domestic companies and specifically for tech companies as well. And that's a really positive sign. And we've seen the likes of Zomato and Swiggy go public at valuations that are as big as anything we've seen outside of a handful of companies in the US, which is fantastic. I guess the question for us and when we're looking at India generally is just how is this a point in time where these happen, or is this the start of a long-term trend? And I think partly it will very much depend on people's experience of investing in the franchise names that come out. What we've seen in other geographies is that this sort of exit market can be quite cyclical. You get the very best companies coming out early in the cycle, and they produce strong outcomes and they increase demand, but there isn't enough supply of the quality needed in order to continue that level of performance. And so you start to see more marginal companies going public, and ultimately they're not able to live up to people's expectations, and so people have disappointing outcomes with them. And then you have a period where the IPO window will shut until you start to see some of the really best companies begin to develop and be in a situation where they are able to go public. So I think my initial take on the Indian public market is I would expect it to be cyclical. I just hope that I'm wrong.
Yeah, sorry about my network glitch. I'm back. So there were two questions here. Thanks, David. I heard most of it. One was, were there any recognizable similarity, trends, characteristics in those historical, what you're seeing on the screen, 40, 50 companies that were billion-dollar fund returners? Was it, were there any, I mean, it's never 100%, but like, did you see two or three top things that actually made these funds realize these massive outcomes? It might be commonsensical, but we'd still love to hear your answer.
Yeah, I mean, the answer is the answer really is not really. I look down. I've just got the list in front of me here. So just going down the list, ByteDance and Pinduoduo in China, consumer internet companies. Adyen is a payments company in Europe. It's the European equivalent of Square, Snowflake, Datadog, Roblox, UiPath, Databricks, Facebook, CrowdStrike, Coinbase, Google, Zoom, Stripe. I think they are clearly companies that can scale very quickly once they get that product market fit, and can scale efficiently with large target markets, and attractive business models as well. I think most of those are software companies where you might be having kind of mid-teens net margins once they get to scale. And so I think it's it'll be harder if you're in a pure play retail business where you're running off much lower margins to potentially, reach those sort of size of outcomes, because I think generally the public markets, will look at the quality of the revenue that you have and what flows down to the bottom line. So I don't think there's any particular trend in terms of, where the companies are based, how they're built, what they focus on. I think it's more around, what do those business models look like at maturity, where you can apply, and what do those growth rates look like. They would be the main things I would kind of talk about around that.
No, thanks. Very useful. There's one other question from someone works with YC China. And do you think the YC model is unique, or rather, maybe a proxy for that is any accelerator model, which has a very tight set of rules around how much capital can be. Your stop loss is almost, dictated. I know Gary Tan came and reversed the idea of a YC opportunity fund, primarily because maybe they didn't want that discretion. They wanted very formulaic. And then it plays into actually extremes of power law, right? Like, one out of 200 companies or whatever on average can become that really large company, but pay for all the other sins because your stop losses are so tight. Do you think that's a better way sometimes to play super early stage or pre-seed or seed, if you can build that kind of a brand in a particular market?
Yeah, I think, we touched on it earlier, which is the earlier you get in the life of the companies that you're investing in, I think the more shots on goal you have to have, because the level of predictability just gets less and less and less. And so, for seed, almost trying to index the market, which is, a little bit of what we're seeing with something like a YC, I think makes a lot of sense. As long as you are, as long as you're able to get, a fair number of what ultimately turn into those kind of top 1% companies into your cohort. Because you need generally for a power law industry, you need a relatively large sample size to make sure that you're getting the biggest outcomes into your cohort. But YC has clearly been an unbelievably successful program and delivered fantastic outcomes, and helped hundreds and thousands of founders build their business. So I think very hard to sort of replicate that elsewhere. I know people are looking to do it. There are various programs. Peak
That's
15
right.
have their Surge program in
Yeah,
India.
in India,
Axel have something similar as well. I
yeah,
think they're trying to replicate that, but whether YC is a bit of a one-off. We have something called Seed Camp in the UK, which has tried
that's
to
right.
do something similar for Europe, and has been relatively successful. So no, I think those models can work, but you have to make sure the quality of the companies and the founders coming in is very high.
Yeah, I think they've created, as you said, like a very unique, highly successful model. I think there was one question to me which was around, how have we evolved, and does market creation versus playing into an existing market and trying to penetrate it. There are two extreme versions of this. I think when absolutely brand new markets get created is where we see outrageous results, because you essentially become like the person who's changed certain behavior. And similarly, when we've tried to penetrate, I've actually written a piece 10 years ago saying the incremental entrepreneur is not ours to back. I'm not critiquing their entrepreneurship or the business model. It just is impossible to get these kind of outlier returns and build multi-billion-dollar businesses against an incumbent unless you have something like magically transformative, right? And so if you see, even Netflix, while it was designed to kill Blockbuster and Hollywood, whatever the second player was, fundamentally they won not because they were a DVD rental company with operations heavy businesses, but actually picked up on streaming, saw that the future of of movie watching is streaming on demand, OTT, rather than actually the conventional DVD format. So that's kind of what we have learned. David, I don't know if you want to add anything to that. And there's a follow-up question from someone else around top three attributes you would look at in new fund managers. So when you're looking at new managers as opposed to existing ones, what would you think about? And please add to whatever I said on my answer as well.
Yeah, no, nothing really else to add in terms of what you were saying there, Kartik. I think all of that makes a lot of sense. Perhaps the only thing is, I remember chatting to Mike Maples of Floodgate a while ago, asking him what was he looking for in the entrepreneurs that he backs. And he encapsulated it in a really good way. He said, I want to find people who are the authentic voice of their community. So they're not doing this because they think they can make money from it. They're doing it because they love it. It's their life's work, and they couldn't think of anything else they would rather do. So I think finding those people who have that passion is just so important, because we know, even with the best companies, they all have near-death experiences. They're facing existential crises on a daily, weekly basis. It's not for the faint of heart. And so
Yeah.
I think you have to have that absolute love of what you're doing, in order to get you through those challenging periods that will invariably come as you're building a business. So yeah, on the question about what would we look for in a new manager? I mean, we don't invest in emerging managers because we don't think we can pick them. So
Yeah.
we wouldn't invest in a fund one, we wouldn't invest in a fund two. Fund three is probably the very earliest we would look to sort of build relationships. And as I said before, ultimately it comes down to, do you have a potential top 1% company in your prior portfolio? And do we think the conditions that allowed you to get that still hold going forward? That's the very first kind of screen that we would look at. And then I think another thing, just for some of the emerging managers to think about, is we have to be comfortable that anybody we back understands what it means to manage institutional capital. So this is not about managing money for friends and family. This is about managing institutional capital. So it means your process has to be in place, your checks and balances, your anti-money laundering, your KYC, all of your systems have to be institutional quality. Your reporting has to be institutional quality, because we're taking a lot of risk, in the companies that you're investing in. We don't want to take any risk whatsoever in terms of how you operate the firm. And I think that's something that is very often overlooked from new managers. They think it's all about putting money into companies. It's not. You have to build an institutional quality firm with institutional quality operational procedures if you want to attract institutional capital from LPs.
Thanks a lot, David. I think we're kind of done here. And Pavitran, if you want to wrap it up, give a vote of thanks.
Yeah, I think, David, can you take this last question? How do you view team transition in VC funds?
Yeah, I think it's essential. And one of the big red flags for us is where we have a manager where we haven't seen any transition in their senior team over a period of time. Because the markets change, the opportunity set change, the composition of the best founders change, and we want to see younger partners continuing to come through an organization and be given room to grow and ultimately become leaders there. The worst thing we can see is if senior people sit at the top, take all of the economics, and don't really do any of the work, and are living off their reputation. So I think that the single biggest reason why we see great firms start to fail is that they don't handle succession early enough, and methodically enough. So team stability is actually a red flag in venture capital. We want to see new talent being recruited and being able to work their way through an organization.
Just an incremental question, David, on that. Like, when you talk about succession planning, what timeline you are looking at? Because it's like a very long timeline, right? So 15-year, 20-year, 30-year period. What time do you see maybe the founding partner moving on, and the next set of folks coming in and driving it?
I think it really depends on the individual. I know you had Vinod Khosla speaking earlier. Vinod is as active today as he was 30 years ago. And the very thought of Vinod sort of stepping aside and retiring is laughable. I think Vinod will keep doing what he loves and until he physically can't do it. But I think you have to understand where each sort of partner is on their journey, and once they lose the passion, then that's potentially when they need to start thinking about moving to one side, letting people come through. We've got another firm who they have a policy where senior partners have to retire at 55 unless the partnership asks them to stay. And I quite like that because it doesn't put the onus on the GP, the individual GP deciding to step aside. It actually puts the onus on the partnership inviting them to stay. I really like that model.
Interesting. Very interesting. So I think, David, I think we covered most of the questions, whatever we had. So one final question, right? I think even when we were preparing, we had this question, right? Firm versus the fund. Like some firms or some folks are starting are good to run couple of funds, but may not to, build like a large firm. So how do you define that?
I'm sorry, but I wasn't quite sure what you mean there. Can you?
So I think somewhere I think in your podcast or somewhere I just listen like some funds, people folks who are new managers, emerging managers who are starting may run for a couple of funds. They can run fund one, fund two, or try two, three funds. After that,
Yeah.
they realize, hey, it's not for me to run for the lifeline, right? Like they are good to run for a couple of funds. It's good to invest in a couple of funds, but not as a firm, right? But as a firm, it's like you said, there's a lot. You have to establish a brand. It's also about succession. It's about a lot of other things like functions which you're establishing. So, what's your view on that? Like, what have you seen here?
Yeah, we've generally had bad experiences when we are investing in a VC's final fund. And so this is why, as we're doing our diligence on a manager, understanding what their long-term aspirations are for the firm is really important. And also understanding, from the individuals what personally they want to be doing and how long, they see themselves involved in this. I think it would be very difficult for us to do something where it may be one or two individuals that will raise a couple of funds and then call it a day. When they get to a stage that they're not, they don't then want to continue to go forward. It's not impossible. There have been some firms that have done that reasonably well. I think the key is being very clear which camp you're in and making sure there's alignment across the partner base as well, so that there are no surprises there. I think the worst thing you can have is doing a fund just because one or two people in a partnership want to do it, but two or three of the others are kind of just there for the ride. Those are the things where I think that really don't work.
Perfect. Thank you, David. That's all from us again. Thank you, Karthik. We're pretty much done. Thanks for joining us, and it was really helpful. See you next
Cool.
time. Cool.
Thanks a lot. Cheers, Kartik.
Thanks. Thank you.
Thanks. Bye.
Thanks. Bye.
Thank you.